To understand this, we have to rewind nearly 250 years to the birth of American debt itself. From the Revolutionary War to the modern-day Treasury bond, the U.S. has always relied on borrowing. Alexander Hamilton, the nation's first Treasury Secretary, famously argued that debt could be a national blessing if managed properly. It would build trust, fund wars, and fuel growth. And it worked. US debt became the safest investment on earth. When people bought Treasury bonds, they weren't just lending America money, they were investing in stability itself. But here's the twist. The very system that made the US dollar invincible also planted the seeds of potential collapse. Because to keep the world's faith, America must always pay what it owes on time, every time. Origins of the modern debt machine. 30 to 4 o'clock after World War II, the U.S. emerged as the world's economic superpower. The Bretton Woods system tied global currencies to the dollar, and the dollar was tied to gold. Then, in 1971, President Richard Nixon cut that link. The dollar was no longer backed by gold, only by trust. From that moment, US debt became a promise backed, not by metal, but by reputation. And because investors believed in that promise, the U.S. could borrow more. A lot more. Fast forward to today, America owes over $34 trillion. Every second, that number climbs higher. And the government must borrow even more just to pay interest on what it already owes. But this system only works as long as Congress authorizes more borrowing, the infamous debt ceiling. The breaking point, 4 o'clock to 5:30. Now imagine what happens when politics collide with math. In 2011, the U.S. came within days of defaulting because Congress couldn't agree to raise the debt ceiling. The result? Stock market plunged, the dollar weakened, and for the first time in history, America's credit rating was downgraded. Then again in 2023, the world watched another standoff, one that nearly froze global markets. Here's why this matters. If the government actually missed a payment in Treasury bonds, military salaries, or Social Security, it would signal one thing to investors worldwide. The U.S. can't be trusted to pay its bills. That loss of confidence could trigger panic. Interest rates would skyrocket. The dollar would fall. Other countries might rush to dump their U.S. holdings, sending shock waves through every economy tied to it, which is, essentially, the entire world. The fallout, 5:30 to 6:45. Let's say the U.S. defaults just once. What happens next? Banks and pension funds around the world hold U.S. treasuries as their safest assets. A default would suddenly make those assets toxic. Credit would freeze. Businesses couldn't borrow. Paychecks might stop. Remember 2008? That was triggered by bad mortgage debt. A U.S. default would be worse, because this time, it's not just one market collapsing. It's the foundation of global finance itself. Even if the U.S. quickly reversed the default, the damage would linger. Investors would demand higher interest rates forever, costing taxpayers trillions more. America's risk-free status would vanish, and the dollar's dominance could start to fade. Failed fixes and repeating patterns. 6:45 to 8 o'clock. You might think, can't the government just print more money? Technically, yes, but that would trigger inflation, devalue the dollar, and make the debt even harder to repay. Every decade, the same story repeats: rising spending, political gridlock, temporary fixes, and each time the stakes grow higher. The Congressional Budget Office now warns that by 2050, U.S. debt could exceed 180% of GDP, levels unseen since World War II. The difference? Back then, America had victory, growth, and unity. Today, it has division, slowing productivity, and soaring entitlement costs. If nothing changes, the U.S. won't need to default to spark a crisis. Markets could lose faith all on their own. Modern parallels and warning. 8 o'clock to 9 o'clock. We've seen this story before in Greece, Argentina, and even ancient Rome. Empires fall not from invasion, but from insolvency. Right now, the world still trusts the dollar. But history whispers a warning. No empire stays solvent forever. And as interest payments consume a larger share of the federal budget over $1 trillion a year, that trust is starting to erode. The question isn't if the debt will become unsustainable. It's when markets decide they've had enough. Closing takeaways. 9 o'clock to 10 o'clock. So, what can we take away from this? Debt is a tool till it becomes a trap. The U.S. system runs on confidence, not cash. Lose that confidence, and the entire structure wobbles. Politics now pose the greatest financial risk. Default isn't about money, it's about decisions. Global stability depends on us credibility. If the U.S. falters, no nation is insulated. So as you watch the next debt ceiling debate, remember it's not just political theater. It's the world's most dangerous game of chicken, with the global economy on the line. The U.S. has always paid its bills. The question is, for how long? If you found this breakdown thought-provoking, hit subscribe. And share this video with someone who still thinks a U.S. default is no big deal, because understanding this story could one day mean understanding the next global crisis.